Hello, my name is Steve Bigelow with the Candlestick Forum. There was kind of a market reversal again this week. Now, the Dow traded positive on Friday, not necessarily a reversal signal. However, you can see where it was supporting at this level. And notice how there might be a wedge formation setting up. So now that gives the prospects of maybe upside to this level, but worst case scenario, probably trading sideways. However, this is again an illustration of why you don't have to use just one indicator as far as an index. The NASDAQ is doing what we call the classic pattern with a J-hook plus. We were training this signal this past weekend in our weekend training class. Notice how the J-hook started with a MorningStar signal that came right back to the 50 and bounced up. Now, the reason we call that a J-hook plus is because there's a J-hook pattern potentially setting up at a level that everybody else is watching, off the 50-day moving average. Positive trading, especially breaking out through this level, would now make this level the potential target. The S&P 500 did another J-hook type pattern, but we call this the bobble breakout. This is where they came up to a resistance level, they failed, did a J-hook MorningStar type signal that if this opens positive tomorrow, the reason the J-hook plus and the bobble breakout are very powerful, just as powerful as a J-hook, if not more so, is because everybody's watching to see what's happening at this level. Whereas on a normal J-hook pattern, you might not have anything that's showing a support or reason why other people are buying. So if the market's open positive tomorrow, puts the Dow in kind of a wedge formation, not really selling off, and giving the J-hook pattern boosts as far as the S&P 500 and the NASDAQ. So you can use that same information for individual stocks. Again, here is your what we call the classic pattern. There's your fry pan bottom. There was your pullback, smack dab to the 50 doing a Morningstar signal. These produce extremely high probability expectations that wave 3 could be fairly strong, bringing you all the way up here to the 200-day moving average. Now, a J-hook pattern doesn't necessarily need to be a pullback. It could be a wave 1, wave 2, and notice in our recommendation of last week or a couple weeks ago after the best friend signal, AEHR moved sideways right until the T-line caught up. Now, what are the prospects? Wave 3 could be the same magnitude as wave 1. Now, the J-hook plus, as you can see, and a recommendation a while back on AMAT was based upon this Morningstar signal with a best friend gap up, doji gap up off the 50. And if everybody and their brother is watching to see what's happening here at the 50, and you see a strong buy signal, where do you think the next likely target's going to be? Everybody's waiting to see what happens when it gets to the 200. So again, this is not rocket science. This is just using the patterns of human nature the Japanese rice traders have illustrated for us. So we can see positions setting up, IONQ. If this opens positive on Friday or on Monday, there's your bobble breakout. And notice how the T-line acts as a very strong support level when using candlestick analysis. Same scenario on MSTR. If this opens positive, giving you a bobble breakout, makes for a very high probability trade entry strategy. So anytime we can see a pattern setup, like your classic pattern, a fry pan bottom, what do we expect coming out of a fry pan bottom? A strong price move. What do we expect for a prerequisite as for a J-hook pattern? A strong price move. And now you can see the J-hook pattern setting up. Even if you miss this move, you can pretty much calculate this wave here should be about the same magnitude as this wave right here. So you can use that whether you're trading stocks or buying options. Bidu, you can see the classic pattern. You can see where they pulled back. You can see where they started back up. Now your probability factors are that it's heading higher. First target, the top of the channel. Second target, same magnitude as wave one. So these patterns obviously work better when you can see that the markets themselves are producing the same patterns. Remember, investor sentiment is the graphic depiction of everybody buying and selling during a specific time frame for all trading entities, whether you're trading indexes, ETFs, currencies, commodities. Anything that has fear and greed in it is going to produce the same patterns. That'll be it. We'll see you in the chat rooms.